Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is Chris Vermeulen. Chris, how are you today?
I'm good, Tom. How are you?
I'm great. Chris joins us from the technicaltraders.com. Chris, before the call, we were talking about how there's a big price inflection date trigger coming, especially in the NASDAQ. Could you tell us a little bit more about that, please?
Sure. Yeah. Well, the stock market's been having this massive rally. NASDAQ's up just over 40%. Well, actually, it was up 40% yesterday until the last 30 minutes. And then the market took a nosedive and fell 2% based on coronavirus kind of flare up overseas and more concerns there. But, we've seen this massive rally in the NASDAQ. It fell 35%. Now it's bounced 40%. It's very similar to what happened in 2000, where the NASDAQ fell 40% and then rallied 46%. We're kind of at that Fibonacci retracement level where it hit in 2000, and it's also just a resistance level on the chart, indicating that this is a typical price level where price should rebound to, and then it should roll over and continue to go lower. And based on cycle analysis and a lot of different things, we're at this inflection point with the NASDAQ. And really, it's not just the NASDAQ. It's the Dow, the Russell, and the SP 500. They're all forming more or less a head and shoulders formation. Now, the NASDAQ has outperformed because it's tech heavy. And really, it's just a handful of tech companies which are actually benefiting from this crisis are pulling the whole market higher. And if you look at the NASDAQ, the SP 500, Dow, and the small cap index, they're all forming what looks to be a head and shoulders formation. There's distribution selling going on, meaning the market makers are allowing the price to drift and run higher outside of regular trading hours. And then when the market opens or at the closing bell, there's huge distribution selling. So there's big selling going on. These are all the signs of a topping phase. But the market, the big money players are allowing people to continue to be convinced that the market's going higher, that everything is good. But behind the scenes, things are not good, the technicals and even the fundamentals.
Absolutely. And as we were speaking about, the P/E ratios are even more ridiculous than before the crash. As you were saying, there's less earnings, but almost some of the same prices that we were paying before the crash happened. And it's almost like the U.S. stocks are ignoring the meltdown.
Yeah, and that's the thing is the P/E ratios are more out of whack. People are paying now more per share than they were before the crisis because earnings have dropped 20, 30, 40, 50% for some companies. Like, it's just insane how this is going to drag out going forward, several quarters worth of earnings. And the stock prices haven't fallen that much. The stock prices, a lot of them are only down 15 or 20%, but earnings are going to be down, 20, 30, 40% easily over the course of the next few quarters in total. So people are paying a premium. They don't realize it. Most people aren't even thinking of PE ratios, but fundamentally, the market is way worse now. To me, it's a big sell signal on a fundamental basis. And it's just not a good place to be, I think. I think this, you look at the money moving into the market here, it's light volume going up. Typically, TD Ameritrade's had a record amount of new accounts opened in their first quarter. They did almost 700,000 new trading accounts. And those are just average Joe Blow traders really piling into the market. They have no jobs. They're excited about the volatility. People think when there's huge volatility, they need to get into the markets and trade it, which in reality, it's kind of the opposite. You actually want to step back and be more cautious and trade smaller positions, which is what I do. New investors are like the mosquito to the electric, the zapper light. You get volatility in the stock market and all these people who don't know enough pile in and it attracts them. It's like an earthquake spike and they're like, oh, what is that? And so everybody's piling in, and this is the suckers rally is what I think it is. Everyone's buying into this market and they're going to be left holding the bag at the top. And this is what I touched on. We're seeing small people accumulate shares here. And there's big distribution. So the big money players are dumping shares into the average Joe's hands, and they're walking the price up week after week. And you can see it happening on the intraday charts. And this is what happens all the time, unfortunately, is the average person who doesn't know enough is going to get completely slaughtered. They're going to be buying right here. They're going to be panicking out when it, breaks the March lows, and or holding, and it's going to go much lower. So it's a tough market for those who don't understand what they're getting into.
Chris, one of your guys' favorite, let's say, small trades, as you talk about, is natural gas. What do you see coming price action there, and is that going to affect the cost of people heating their homes going forward?
I like natural gas. I mean, we had a couple really great trades last year in it, and we've been waiting for the next bottom to form, which took way longer than we ever expected. But we had a buy signal about 2.5 weeks ago, and market ripped to the upside. We did a quick 11% gain on the trade, get in, get out. But overall, I still like natural gas. It is getting oversold again. It's getting down at a support zone. I think it could continue to move higher. Seasonality-wise, natural gas tends to move higher into early June, and then it's done for more or less the summer. So the trend and the bias is to the upside. It's got higher lows, higher highs. It's down at support. It's oversold. So it is looking primed and ready for another bounce. Now, there are some other issues overseas. The liquefied natural gas tankers, places are full. And it's just the same issue with crude oil. They don't want to unload it. They can't unload these tankers of natural gas. So there's going to become more of a glut of natural gas. And I think that's why we're seeing this drop, is because loads are being rejected because there's nowhere to put it. So it's going to be interesting how it moves here. Overall, though, I still have a bullish bias until it breaks the low from about 2.5 weeks ago. If it does, then it's back into kind of no man's land. But I like natural gas, and I think it trading down at these levels definitely keeps things very affordable for heating and for using the resource.
And as you're speaking about oil, could we see negative prices again?
I think it could be possible on the front month contract during that last week when no one wants to be stuck with 1,000 barrels, because if you own the contract on expiry, you're stuck with 1,000 barrels. And if you're just a trader sitting in your bedroom, you're going to be screwed. So that is the fear with a contract that expires and it delivers versus like the SP 500 Mini, which is just a digital contract. It expires and cash goes to your account. So there's going to be there's this new fear factor in holding a contract, the commodities, that it could go negative. And you could have to take delivery. It could be very costly. So I have a feeling it probably won't, but I think we could see that value potentially go right back down to zero pretty much. I mean, there's going to be a lot of panic selling those last couple of weeks as every day it gets closer to expiry. People will be like, you know what, I think I should get out now. And it's going to just run the price down as people kind of panic.
Very interesting, Chris. As we're very focused on gold and silver, and we've looked at the price action of gold kind of bouncing back and forth right around 1,700, you guys seem to have identified a bigger move coming in silver. And there's 4 things that tend to happen in a crisis. What can we look forward to with silver? Yeah, well,
silver's it's the little kind of cousin of gold. Everyone kind of naturally flocks to gold as a safe haven currency globally, and that's why gold has been outperforming, as it's really seen as an asset around the world. Where silver, to me, is a little more of a a lot more of a speculative metal. It's more North American based, in my opinion, in terms of people trading it for speculative versus gold as a long-term store of value and kind of like an insurance plan in case the financial system collapses. But overall, silver has got this pattern on it that it's primed and ready to have a really sharp move to around the $18, $19 per ounce area. And it could really go parabolic and take off and have a run much higher up into the 40s and beyond. So overall, I think we're getting close to a scenario where we saw back in 2010, 2011, where once silver starts to pick up steam and starts to break out above that 19-ish level, maybe 20 level, then I think we could really see it take off, because the gold-silver ratio is way out of whack. And when we see the ratio this far out of whack, we tend to see silver rocket higher. And it doesn't mean gold's not going to go up. It just means gold will rally, say, 10%, where silver could rally 40 or 50%. And there's just a big disconnect of which one has a bigger potential gain. So overall, silver is primed and ready. It hasn't broken out yet. And as you and I talked a couple of weeks ago, I'm kind of waiting for silver to break into a bull market versus trying to pick it up down here at this level. I'm not afraid of buying it at higher prices. I'd rather buy it at a higher price knowing the masses are just starting to pile in and they're going to drive the price up right away versus it trading between 15 and 18 for potentially months and your money's just kind of drifting around and you're doing that roller coaster ride. I like to jump into stuff with a strong trend and big power behind it, just so you get that immediate gratification of, week after week, it's driving higher.
When you're trading trends, Chris, are you looking to kind of day trade that, or is it a buy and hold for more than a couple weeks type thing?
Yeah, so typically for like swing trading, for like a silver trade like this, I mean, if you were to get into this current pattern right now, I would think in over a 3 or 4 week period, it should be back up at that 18, 19 area. Most trades that we do last anywhere from a week to 3 weeks. Sometimes they drag out much longer, but typically trades are the week to 3 week kind of window. Those are the patterns we're looking for in the charts.
As we all know, gold and silver are a great store of value, especially in a time like this. And with the fiat currencies, some getting pounded, some going up. How do you see cryptocurrencies fitting into that picture?
Yeah, the cryptocurrencies are tough. I mean, I don't follow them too closely just because there's not an easy way to trade them as a trader unless you want to get into having all the wallets and stuff. And to me, it's kind of a no man's land out there. And I'm not a huge fan of the crypto because of that. And if you look at what's been happening with Bitcoin, it's really volatile. I think it could continue to correct in a big way. If the stock market falls, I think we're going to see Bitcoin pull back in the cryptos. And it's not really a store of it's not like a safe haven. It's not a store of value. And I've got some friends who are heavy into cryptocurrencies. They've helped launch cryptos. They got paid in crypto. I mean, and they're a younger generation. They're in their 20s, and they made a ton of money going forward. They became fairly wealthy, and then suddenly the market collapsed, and they made absolutely nothing. And they actually have less now than they did a long time ago. And they don't realize you need to actually sell the asset, the position, in order to kind of cash out. And they think that obviously a lot of cryptocurrency people think crypto is a store of value, but it's actually not. In my opinion, once you cash out, you need to go to a real store of value, which is, believe it or not, it's a fiat currency. You've got to get rid of the digital currency. You got to go to like the US dollar. You got to cash out. And while the fiat currency, you could say, isn't a real currency, it still has real value. It's not nearly as volatile as Bitcoin. So you have to cash out and get back to cash. And it is a store of value. And that's kind of the thing that a lot of traders in the crypto world don't understand is, and they get stuck in the wallet. They move from one current crypto to the other trying to hedge it. But if you look at them all, they all follow Bitcoin. So it doesn't matter which one you're in. You can't just sell Bitcoin once you make money and go over to the whatever the other ones are and expect Bitcoin to fall, and then you'll move back into Bitcoin in the bottom, because once you move to the other one, it's going to fall as well with Bitcoin. So you actually have to cash out to a real currency and kind of pocket that money. So it's a tough market to trade. I mean, I've done it a couple of times, and I just don't like it. It's not my thing.
Excellent. As you were talking about the Bitcoin price could crash when the markets do, could we see another reversal like that in the gold price?
Yeah, I think it's possible that we could see gold have a dip, although I think it's a little different this time. So the crash that we saw in Bitcoin and the stock market and gold, pretty much everything actually in March, that was because of a couple of things. First of all, everyone knew earnings were going to be bad, so that created fundamentalists to start selling positions. And we had a virus where people didn't know what was happening. The world was locking up. People are dropping dead on a daily basis, and it was picking up speed. People were actually afraid for their life, so they sold all their assets and cashed out. And that's why everything just fell. When you're worried for your life, who cares about money? Just cash out of the positions, go to cash and survive, right? And that's why everything fell. This time around, I think, is a little different. This time is the fundamentals are now more in place than ever, that we're starting a bear market. The fundamentals make no sense. Earnings are going to be bad for much longer than people anticipated. It's going to bleed over into next year. And I think we're starting a bear market. And I don't think people are actually scared for their lives right now. It's just people are going to be scared about losing money. So they're going to be looking for a safe haven asset, not just cashing out of everything. And I think that's where metals could actually hold up really well, because we're not going to have panic, life or death selling in the market. It's going to be people actually strategically moving to hot sectors, hot commodities, and out of, the ones that are starting to fall. So I think gold should be the most buffered. It should hold up the best. If not, it should rally. I think gold miners might be under a little bit of pressure, because there will be broad market selling and some panic, and typically those stocks get pulled down with the rest of the stock market to some extent. But I think the metals market is going to actually still do fairly well going forward this time around.
So in that case, Chris, do you think we could see even a bigger spread develop between the paper and the physical market?
Yeah, it's interesting how all that's unfolding. I mean, if we have this massive jump in demand for physical metals, I think the writing's on the wall that it's just not available. And I don't know the full details on it. It seems like there's a ton of gold that's shipped on standard flights. And that was the big issue of not just being able to get the gold from one location to another. It's not that it wasn't available. It's just it wasn't available at the location that gold, was required for delivery. And I think that created that big change, because really there aren't too many airliners flying through the sky. I mean, I used to see dozens here a day, and I see like one a week now. So I think that whole spread might not get too bad, but if there is a real default once airlines get shipping this stuff, I think that spread could get pretty gnarly. And it's a short temporary thing, but if it happens enough, then it might actually be real and legit. And of course, everyone's out there saying, there's not enough gold, everything is fudged, everything's manipulated, and I don't disagree, but you got to let it play out the way it is, because we've all thought that from day one, and it doesn't change our mindset and how we have to trade it. At this point, if the spreads start to change, I mean, you've got to adjust your trading or your asset. Are you going to buy physical, take delivery? Are you going to just trade the digital? Kind of interesting, but I'm not sure how exactly to trade it at this point.
Excellent. Any concluding thoughts as we wrap up here, Chris?
Well, I think in general, I mean, you got to be really aware that the stock market is on the verge of having a major downdraft, potential double dip at minimum. I mean, almost every time we see a crash in the stock market, whether it's an 8 or 10 or 15% drop, like we saw in March, like a very sharp panic selling, we almost always see a double dip. You go back in time, I mean, double dips are, 95% going to happen. So that's the fear, is people don't realize there's a double dip most likely coming. And the question is it a double dip, or is it the start of another leg lower, way lower? And so investors need to be aware of that. And that's what I'm kind of really covering now, is from an investor standpoint with our investing signals, is you need to be aware of this, when to cash out, how to take advantage of this drop, because everyone has a nest egg, everyone has a retirement account, and there's no way you want to go through a 40 to 60% drop over the next several months if this bear market unfolds. So you can actually profit from the fall and then have more money to invest at the bottom, and you can make so much more. So investors need to be aware this is one of those times in their lives. This only happens 2 or 3, 4 times in your lifetime. And this is when you can either make it or break it. It's, do you retire 5, 10, or 20 years younger? If you trade your long-term investment right. If you don't, you work till you're 70 or 80, and that's just the way it goes. So This is a really important time for investors to focus on what to do with their retirement account, their long-term, mutual funds, and all their different types of accounts. It doesn't matter where you are worldwide, really.
Is it possible that there's an event that precipitates that next leg lower, or is it going to be the market's just starting to slide and people selling into that pressure?
I think the next leg could spark with another flare up in the coronavirus as they start to ease and let people mingle with each other. I mean, I think we could start to see that pick up. And if there is any type of half decent flare up and any type of restrictions that come back into place saying, hey, we're closing malls down now. We opened them. That was a mistake. They closed them down. I mean, if they start to see things close down, that's going to instantly spark a massive sell-off. And that could be the catalyst. That could be the trigger that sends us down to the double dip. And depending on how big that flare-up starts to happen or drag out, I mean, I think we could be going lower. So to me, that's going to be kind of the catalyst, just enough to just, push the rock over the edge. But really, I already think the damage is done for a bear market. It's coming. It's just the question is, does it start has it started as of yesterday? Is it starting on a month or 3 months or 6 months from now? When does it actually kind of roll over and start to pick up speed to the downside?
Everybody can find Chris on Twitter at the Tech Traders and the technicaltraders.com. And if anybody has any questions or comments about today's show, please email me at tom@palisaderadio.com. Chris, thanks for your time today.
Hey, thanks for having me on, Tom. Appreciate it.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?